Good evening, everyone, and welcome to the fixed income outlook for UTI mutual fund for the month of September 23. In this outlook, we will discuss what were the key events which happened in the month of August and what's our view on market going ahead and the recommended products uh, for the same. So we'll start with the global trends, where we'll follow up, the domestic activity and what looks attractively priced on the yield curve. So coming to the global trend, as we can see on this chart, the manufacturing sector continues to be in a slowdown since the rebound post the COVID reopening. If we see on the left hand side of this slide, we have the global manufacturing PMI, which has been below 50, since almost a year now, and is continuously on a slowdown path. That's also reflected in the global trade and output volumes data. If we see on the right hand side of the chart, so this industrial production ex construction, which is the black line, and kind of topped out in 2021. The same we can see for trade volumes, which were about 25% up YOY in 21, and since then they have been on a decline. In fact, trade volume has been negative for a while now, and as we can see, even global industrial production is almost flat. In fact, it's if we see the last 8-year chart, it's been at its the trade volume as it's been lowest, also reflecting in the realignment of supply chains as it is happening globally. Coming to the next slide, this is the commodity and food index trends. If we see the commodity index, which is on the left-hand side, made a high of 136 in June 2022, just post the Russia-Ukraine conflict. On the, as the supply chains normalized, it made a low of 98 in May 2023. But since then, it has, increased moderately. The reasons has largely been on the food prices because of the extreme weather conditions. In fact, July this year has been the hottest on record. How much will this impact inflation will depend on the import intensity and the consumption basket of every economy. So this will not have a one-to-one impact in every economy. It will depend on whether those particular economies are self-sufficient, they have adequate buffer stocks, what is the kind of fertilizer, seed production in those local economies, and how they're able to tackle even the distribution for commodity prices. So as we know, in India has taken a lot of active steps, whether in wheat, in rice, as well as in edible oil, to control the intensity of these extreme weather events. The same if we see in the food index, which is on the right hand side, it made a low of in somewhere in April 23, has been, although it has been upwards, it's still declining and negative minus 11.83% on a YOY basis. The second impact that we are seeing on the commodity space is the rise in oil prices on account of OPEC production cuts. If we see the blue line in this chart, which is the OPEC production, since early part of this calendar year, it has been on a declining trend. At the same time, if we juxtapose it with the US Strategic Petroleum Reserve, which is on the right hand side, and as you can see on the orange line of the chart, earlier there was expectation probably that oil prices, if they will continue to go down, that the US will be able to refill that capacity at a reasonable price. But since we have at one hand we have the production going down, and also the US Strategic Reserve also at its 20-year low. and hence you also the oil market participants are also concerned that probably there is a latent demand that the federal government in the US could have, irrespective of the prices in the near to medium term, and that's also leading to a spike in oil prices as well. Uh, so far, they are still reasonably well behaved for India. There is no need of worry, both from a fiscal or a current account perspective. On inflation, since retail prices are so far unchanged, there is no major impact on inflation as well. We will need to see the reaction on how the oil marketing companies manage in case oil prices continue to climb upwards. Probably somewhere close to 95 to 100 is somewhere the market participants could be concerned on the impact of fiscal as well as on inflationary pressures. If you look at global inflation, clearly it seems to be moderating from the highs that it made last year. If we, for example, if we look at the US, which experienced a 9.1% YOY inflation in June 2022, the last inflation print of 3.2 is way below the peak we saw in 2022. Same we can see for the UK, Japan, ECB, and Canada. So broadly, we can reasonably assume that now inflation is on a declining trend. However, for central banks, since they have seen inflation well above their targets of 2% for most of these advanced economies, it will require a consistent drop in inflation, as well as inflation being close to their target of 2% for them to pivot meaningfully, which basically means for a sharp series of rate cuts, it will require inflation to be close to the central bank targets. While the journey so far from let's say inflation from 9 to 10% to 3%, although difficult, was still possible on overall slowdown pressures on base effects as well. Is the journey from 3 to 2, which could be slightly more challenging in absence of a major recessionary shock, because as the supply effects fade out, it will still require a meaningful demand compression, probably for inflation to get close to these target levels, and hence probably we should expect inflation to largely remain range bound in the next 3 to 6 months before we can expect inflation to come close to these central bank target levels. This is the table which reflects the 10-year sovereign yield movement in key economies. As we can see, post the lows that, for example, the US 10-year made in April 23, which was 342. Since then, the 10-year yield has been moving upwards. Largely, the same movement has been seen across all the major global economies. If you look at UK or Germany, the reasons, like I explained initially, was one, the spike in commodity prices due to extreme weather events, which is leading to a concern that inflation could be slightly higher than longer. And secondly, like we just saw the previous slide, it's the journey from these 3 to 4% inflation to 2% inflation, which could probably happen meaningfully in a major recessionary shock. And since that's overall global economy has proven to be quite resilient, and hence the concern of market participants that probably these high interest rates could remain higher for longer. And it's the higher for longer theme which is leading to this climb up in major economies and the bond market. If we see across the major advanced economy world. The only exceptions that we have been seeing are the southern American economy like Brazil, Chile, etc. For example, as we can see in Brazil, the overall yield movements have been on the lower side, largely because it was one of the initial banks to hike interest rates well before the advanced economy central banks, and as inflation has started to go down, the market expectation of rate cuts is also increasing there. Coming to domestic trends, we had the GDP growth data which was published in the month of August. As we can see, for the quarter ending June, we recorded a GVA of 7.8%, with manufacturing or industry largely stable, as we can see, 4.6% growth compared to March 23 quarter of 4.7%. Uh, Agriculture took a slight knock, printing at 3.5 compared to 5.5. But the main boost to growth came from services, which we saw move from 7.4% to 10%. If we see the breakup of the services sector, uh, financial, real estate, and professional services was a major contributor, with growth going from 7.1% in the fourth quarter of FY23 to 12.2%, and even the trade holdings communications held up quite well. The same service sector growth is also reflected in the consumption. So if we look at the GDP numbers, which also came at 7.8%, private final consumption expenditure, which is about 57% of the GDP, grew from 2.8% in March 23 to 6%. If you look at even the gross fixed capital formation, which contributes about 32% to GDP, that remained high at 8%, also reflecting the central government's capex push. While the consumption numbers are quite encouraging, but for this GDP growth numbers to sustain, this will require a broad base of consumption, as well as more pickup in private investment, which is still on the softer side. So yes, this GDP number was encouraging, but for this to continue, we need to see consumption holding up for the upcoming quarters as well, which could be slightly challenging given the weaker monsoon, especially on the rural side. Hence, policymakers will be keenly looking at probably the support which we need to give it to the rural sector, and probably we could see some softness in the GDP prints in the upcoming quarters, as this boost from consumption starts to slow down. Coming to the coming to the inflation, if we look at the headline CPI for July 23 printed at 7.44% compared to 4.87%, largely driven by food price shock. So if we look at the individual breakup of this inflation, as we can see the red line on this chart, the core CPI continues to be well behaved, and in fact it's been continuously moderating since February 2023. It's the food price shock due to these extreme weather events, especially on the tomatoes. In fact, tomatoes were up 201.5% for the month of July. And if we look at overall food inflation, it doubled from about 5% to 10% in the month of July, thus contributing to this inflation. We do not expect RBI to take any rate action because of this one-time effects of this inflation. We believe that RBI will want to see the second round impact, whether this transient increase in food prices translates to increase in core inflation as well, before taking any policy action. These are largely seasonal shocks. which typically take place in the months of monsoon because of irregular rains or some other weather events like extreme heat, etc. And they tend to normalize, as the uh, upcoming crop for winter arrival starts to hit the vegetable markets. So probably at this point of time, do not expect RBI to take very strong notice of this temporary spike, and probably ignore these high prints for at least for a couple of months. This is the chart on the banking system liquidity, with the blue line signifying the interbank liquidity and the orange line signifying the daily MIBOR rate. As we can see from this chart, on the 8th of August, the RBI MPC announced the ICRR, almost equivalent of 1 lakh crores or 10% of incremental NDTL between the month of May to end of July. And as we can see, post the announcement of ICRR, the daily MIBOR rates had started to inch up and were consistently above 6.5%. So if we can see this orange line, as we can see till the announcement of the ICRR hike, it has been somewhere below 6.5, which is the policy rate. And after the announcement, it moved meaningfully above 6.5, between 6.5 to 6.7%, till it again came close to 6.5 at the month end due to month end government spending. But broadly, we believe that RBI in this withdrawal of accommodation phase will keep liquidity slightly on the tighter side, with basic objective being policy rate keeping the policy rate close to the repo rate. And hence we believe that whether through combination of either measures like ICRR, or since now it will be withdrawing ICRR by announcing triple R's of variable rate reverse repo auctions, RBI could keep overnight rate close to the repo rate. This is the chart on progress of monsoon. So as we can see from the chart, it has been a story of quite uneven rainfall across India, across this whole the season of monsoon of June, July, and August. So if we look at starting from for all India, starting from June, in June we saw a deficit of minus 11% compared to the long period average, and that deficit got covered reasonably well in the month of July, which experienced 14%, better than long period average. But again, that surplus got kind of offset in the month of August with a 36% lower rainfall than long period average. In fact, the month of August was the worst on record since the records of rainfall have been kept in 1901. If we see, apart from the east and northeast, which experienced a 2% surplus rainfall compared to long period average, all regions, and especially the southern region, experienced a very low and chronically deficit rainfall in the month of August. If we look at the sowing data, rice data, the rice sowing has been largely in line as compared to last year, and even on the sugar cane, which bodes well for sugar prices. But if we look at pulse prices, the sowing has been 8.5% lower compared to last year. So it's the further move and the further movement in pulse prices, which probably the policymakers will be keenly looking at. Also, because of this uneven rainfall and this August rainfall being significantly lower, even the yields on these crops where the sowing has been normal, for example, rice or oil seeds or sugarcane, even the yields on these crops, or which is basically the production, would also be affected, which could also influence food inflation trajectory going forward as well. So this is something that policymakers as well as RBI would be keenly observing whether this remains a one-off, or it imparts a slightly structural upward bias to inflationary pressures in this fiscal year. So coming to the fiscal trends, so this is this chart largely reflects the tax collections for the month of July, as well as we also compare the fiscal year to date, which is the April to July collections for year 2024 compared to 2023. So as we can see, the corporation tax for fiscal year to date, April to July, has been 10% lower compared to last year, whereas income tax is slightly upward, around 5%. Again, excise duties also have been lower, about 11% lower, whereas GST has been, the collection has been quite strong, of 17% compared to last year. So although subsidies are up 29% compared to last year, since we will not give it too much importance right now, because the payment, the release of payment for subsidies tend to be quite uneven, and it's too brief a time period to correctly capture the trend. Even on the budget note that we had discussed when the fiscal year budget was released in February 2023, we had discussed that given the expectations of a lower nominal GDP, the tax collections this year could be slightly lower than government estimates. So as we can see, especially on the direct tax side, both the corporation tax as well as on the income tax are low compared to the trends that we saw last year. So probably, but having said that, since it's just been 4 months, maybe we will wait for a couple of months to fully assess the impact of lower nominal GDP on these tax collection, as well as on the impact of fiscal deficit. As per our opinion, it's too early to say whether these tax collections will have a meaningful impact on fiscal deficit right now. Mind you, that this year the RBI dividend has been much higher than what was budgeted by the government of India, and hence, at least for now, we do not expect any material change in fiscal for this financial year. Coming to the trade deficit, as we can see, the trade balance continues to be that about 20 billion, majorly coming from oil. If you look at the oil imports in June 23, the oil deficit, which was about 5.8 billion, moved to 7.2 billion due to higher oil prices. Whereas if you look at non-oil imports, it's been largely flat. So the oil prices will need to be continuously assessed to see the impact of trade deficit going forward. However, because of very high service exports, we do expect this trade balance to remain manageable for the current fiscal year. Coming to the bond valuations, as we can see, yields hardened across the curve as rate cut expectations pushed back, like we discussed when we were discussing the global trends as well. So the earlier bond market expectation that probably inflation has peaked, and the global growth will experience a major growth shock, and it could lead to central banks cutting rate in the near term. That got pushed back as growth seems to be quite resilient, especially in the US, and hence, and especially with the weather shocks leading to higher food inflation. Overall, the repricing in the bond market has been that the rate cut, which probably market would have expected this financial year from RBI, has gotten pushed back to the next financial year. That got reflected in yields across the curve. So whether we look at the 1 year, 3 year, 5 or 10 year, across the government bonds, AAA or AA bonds, it's largely got pushed upwards. So what kind of products make sense? What's the outlook? We do expect that one, the global growth as well as the domestic growth drivers are still resilient. Although growth could moderate from here on, but we are not seeing a major economic shock that will lead central banks to ignore price stability in favor of macro stability. That is, uh, go for rate cuts irrespective whether inflation has met the target or not. So we are not expecting a major, downside risk to growth for now, barring a global economic accident. And given the upside risk to inflation, especially because of extreme weather events, we expect RBI to err on the side of caution and remain on a long policy pause till they see inflation is well under control. Also, given that globally, rates are still in the restrictive territory and major advanced economy central banks are still on a hiking path, uh, while RBI may not follow them, but RBI will probably wait for a global rate cycle to stabilize before looking at policy rate cuts. Hence, and then comes the third lever. So one is whether RBI, will cut rates or not, and like I said, that depends on whether when RBI foresees that inflation is well under control. The second, point being that even if when RBI goes for rate cuts, what kind of space does RBI have? While the advanced economy central banks have hiked rates very aggressively, for example, the Fed has done the most aggressive rate hikes since the 1980s. If you look at India, uh, whether you look at forward-looking real rates or the quantum of rate hikes undertaken, it's much less aggressive compared to some of the advanced economy central banks. So when the rate cycle turns and those advanced economy central banks start to cut rates, while they have made more scope to cut rates because the quantum of rate hikes were also much higher, for India probably because India did not hike very aggressively, and rightfully so, because our inflation was not uh, that high, and our inflation was largely supply side led rather than demand side led. The quantum of our rate cuts would also be lower. So, in a period where one, we are expecting central banks to be on a long pause. Secondly, in a period where we don't expect a very aggressive rate cutting cycle from RBI, what kind of products make sense? Well, it also depends on the investment horizon of the investor. It also depends on the risk appetite for the investor. So if the investor has a moderate risk appetite, plus they have a time horizon of 6 to 12 months, a low duration or a money market strategies, which typically run duration between 6 to 12 months, are more appropriate for such investors. Investors who have some tolerance for intermittent mark-to-market volatility and more than 12 months investment horizon may consider allocation towards moderate duration, which is the 1 to 4 year duration category like short-term corporate bond, banking, PSU funds. The reason why we are recommending these products is largely the rate hike expectations either domestically or globally are priced in the market. So if you look at the yield curve today, where a 3 month, for example, CD is trading around 7%, 705, and you have a 3 year, for example, a AAA PSU trading between 760 to 770, there is a decent scope for accrual as well as a reasonable participation in mark-to-market capital gains whenever the rate cut cycle takes place. We do expect RBI to start the path of policy easing in the next 12 months. So hence, investors are getting a reasonable entry point at this level, and also an opportunity to participate in the mark-to-market capital gains when the policy cycle starts to ease off. So that's largely it from our side. Happy to take up questions from our audience. Thank you.
Thanks, Anurag, for sharing your valuable insights with the participants. In fact, you have taken them through how well the market has performed on the debt side as well as given your outlook. So, to start off with, I would just like to maybe start with the global scenario where, though the inflation, I would say, has come down in the US in the last 12 months, the service-based inflation in US looks to be very resilient. So, how do you see Fed tackling this part of the US, inflation? Because it might get the US into a recession if it does not, tackle this effectively.
Right. So thanks for the question. So the service-led inflation is largely a function of two things. One, a very high fiscal deficit, which the US has been running compared to its historical trends. Last year, even in 2022, the US fiscal deficit was about 5.5%. If you look at the rolling 12 months US fiscal deficit, it is in upwards of 8%. It's much high compared to the usual trend rate what US has seen. And if you look at the unemployment for an economy which is at its 50-year low unemployment and running such a high fiscal deficit, it does lead to some inflationary pressures, especially on the services side. Where it leads to is largely a very resilient labor market. And as we can see, the US wage growth has been on the higher side. Even US home prices, which at one point of time, especially in April and May, had started to come down. Again, they have kind of now flattened out, and they are largely flat on a month-to-month basis if we look at major housing indices. So we believe the answer to service inflation is what right now Fed is doing, that keep rates high, be consistent in communication, and at some point of time, as the economy starts to slow down, as the fiscal impulse also starts to fade out, probably the labor market could get weaker. And as the unemployment rate starts to inch up, as the wage growth starts to slow down, that is when probably market participants as well as the Federal Reserve could get better confidence on service inflation.
Anurag, for explaining it well. Anurag, there's one more leading question. I think during the presentation also you touched upon that, crude oil could see latent demand considering that, US strategic petroleum reserves are at a 20-year low. So what would be its impact globally in terms of the crude oil rising, and how will it spill over to the Indian bond markets? So if you can throw some light on that, Anurag.
Right. So we believe, although we are not, I would say, expert on oil prices, but largely the oil market is already considering the possibility of refilling of this strategic oil reserve, and hence we are seeing, despite low Chinese demand and a slowing Chinese economy, oil prices being quite held up because of this fear of intermittent demand from the US Strategic Petroleum Reserve. So like I said, so if you look at high oil prices, they impact India in three ways. Since we are an oil importing economy, they impact us on the fiscal side in case oil prices remain high, because one, it increases the fertilizer subsidy, because of course higher gas prices, higher oil prices lead to higher fertilizer prices. Then it leads to higher current account deficit. So like we saw in the trade deficit presentation that during the was the rise in oil prices, which also led to a higher trade deficit in the month of July. So it increased our current account deficit. And the third is, if those oil prices are passed on to consumers by the oil marketing companies, it also results in higher retail inflation. So tackling these one by one, if you look at on the fiscal side, yes, high oil prices could lead to some impact on the fertilizer subsidies as well, and probably would lead to the compared to the budgeted estimates for FY24, we probably could see higher fiscal outgo on fertilizers. Probably government will have to counterbalance it by lower spending in some of the other items. As we have seen the track record in the last 5-7 years, wherever there has been any higher subsidy outgo, instead of resorting to higher borrowing or higher fiscal, the government has tried to rationalize the expenditure under various departments. It's tried to manage the fiscal within the budgeted numbers that they have presented. So largely, unless and until the number becomes very high, we do not expect it to either change the fiscal maths or change the expected borrowing that they announced to the market during the budget. The second impact is on the current account. So while it will, so the oil prices will have some impact on our current account as well. But given the very high service exports, given the very high FPI flows, given the robust FDI flows, we do not expect oil price even between 1995 to have a major impact on current account. Thirdly, coming to the retail inflation as and when the OMCs pass on the cost, while it's anybody's guess that when OMCs will start to pass on that cost to local customers, but given that we did not see reduction in retail prices even when oil was at $80 and government of India was getting much cheaper oil from Russia, it remains to be seen that whether oil marketing companies will also increase prices for consumers. In the past, we've also seen periods where oil marketing companies have increased oil prices, but the government has offset that with excise duty cuts. So I think till 1995, we should not really be worried on all three factors, although they are marginally negative, but they do not change the big picture on inflation or fiscal or current account. It is when oil consistently stays at 100 or above is when it starts to change, whether you look at Forex or you look at fiscal or inflation, that is when it starts probably to change the maths.
Anurag, for sharing very simply how the government is going to be playing a balancing act in case the crude oil goes up. So sticking to the global side, we have a few questions that have come up, especially leading to on the global side. So we have a participant, Ms. Chetna has asked, the slowdown in China, do you see impacting, the Indian bond markets as much as the global bond markets? So any thoughts on that, Anurag?
Slowdown in China is already impacting global growth. So the first slide that we saw on global trends, where we saw slowdown in manufacturing PMI, as well as in slowdown in global trade volume, that's already a result of the slowdown that we are seeing in China. The commodity prices that we are seeing, which are still well behaved, despite the extreme weather events, despite the OPEC production cuts, are due to the slowdown in China. Otherwise, the impact on commodity prices would have been on the higher side. So probably that's already impacting the local inflationary conditions. And hence, we are seeing a very well-behaved bond market. So I think although indirect, so because of the very differential, the way the bond market works with China compared to India. So Chinese bond market is much more correlated to the US bond market because of the US RMB correlation, and they follow the interest rate differential and the currency differential quite closely compared to India, which is more domestic oriented, and hence it's the impact of Chinese economy on global slowdown and overall cool down of commodity prices, and hence the Chinese slowdown impacts India in a more indirect way than largely assumed in some other areas.
Anurag. So coming closer to home, RBI has decided to phase out the ICRR in a staggered manner till October 7th. So with the upcoming advance tax and the spending by the month end, where do you see the liquidity for the markets? So at one end, you'll see some kind of liquidity infusion, and then somewhere there'll be outgo from the advance tax. So where do you see it balancing out, or how do you see the situation
Yes,
happening?
so barring any major FX intervention, we do expect liquidity to be largely flat from current levels because, like you rightly mentioned, that while there will be an advance tax outflow as well as a GST outflow, around 20th of September, probably that will be offset by the month-end government spending as well as the staggered phase out of the ICRR, which RBI has proposed by 7th of October. So probably both the effect of the ICRR, unwind and the month-end government spending will kind of balance out the liquidity. Probably the reason behind the unwind of the ICRR is also that October will also we will also be starting the festival season, which typically sees higher currency outflow. And there could also probably we will anyways see some pressure on banking system liquidity, higher deposit as well as CD issuance, probably, and some pressure on interbank market. So probably RBI, rightfully so, has unwound the ICRR before the festival season starts.
Thanks, Anurag. So, Anurag, I'm just trying to cover a couple of questions that the participants have given. One is, one participant has asked, especially at the longer end of the duration, Mr. Mahesh has asked that if he wants to take exposure in, let's say 13, 15-year gilts, and, capture the capital appreciation when the rates come down, what is the best avenue available? And considering, I would want you to answer that, especially considering you shared with our participants earlier that, the rate cuts could be very shallow compared to what is going to happen globally. So, in terms of the expectation at one end from the investors that, we could see a series of rate cuts happening, but actually that rate cut could be very limited and shallow. And therefore, what could be the risk reward for somebody who is wanting to take that amount of risk and come at the longer end of the yield curve?
Right. So it depends on the one, the investment horizon of an investor. So if the investor is looking at, let's say, allocation to government bonds as a more consistent and a long-term part of their asset allocation, then they can consider various gilt index funds or SDL index funds, which can benefit them over a period of time. However, if they are looking to benefit from the next rate cycle, which, like we discussed, probably could be shallower compared to the global rate cycle, uh, then they are better off either coming to a moderate duration strategy because it is coming at a very attractive starting point. So, like we discussed today, a 3-year, PSU is trading somewhere between 760 to 770. So, even if you consider a corporate bond or a short-term fund which is invested in these kind of strategies, you are coming at a reasonable high YTM. Plus, there is a opportunity to participate in capital gains once this shadow rate cycle starts. So the risk reward is quite attractive in this category without taking very undue high duration risk. However, in case one wants to invest in gilt funds, we would advise to stick to actively managed gilt funds because uh, you know can play across the yield curve. So let's say, and they can trade more actively compared to an investor who may not be in a position to very, very closely track the market. They may see some capital gains, but by the time they decide to exit, maybe the interest rate cycle could have reversed, or there could be other, dynamics like fiscal or other, issues which could disrupt the bond market. So probably an actively managed fund gilt fund, which can play across the curve, can also help the investor in such kind of situations.
Thanks, Anurag, for sharing very simplistically, I would say, why an actively managed gilt fund can trump over, a normal SDL or a GSEC index fund at this point in time, in this particular environment. So, to lead into, the next question is, do you see, I think there was some news about the state governments borrowing aggressively in the first quarter or the early 4 months of this fiscal relative to what they have been borrowing in terms of the percentages. Does that put pressure on the fiscal side from that perspective?
Well, so see, just like there have been state governments who might have borrowed more than expected, there have been state governments who have not borrowed or who have borrowed less than expected. So ultimately, it has evened out. So if you look at the borrowing calendar of states to date, it has been on an aggregate level, it has been lower than what was budgeted. So that is one. And secondly, we would see all the state governments have to take approval of the union government for their budgets, for their state fiscal deficit and their borrowing program. So whatever borrowing they may do, it may have a temporary time mismatch because of various cash flow constraints. But the aggregate borrowing for the states is in accordance with the pre-approved plans that they submit to the central government. And hence, since the fiscal deficit percentage is capped and the market borrowing is capped, it's only a timing mismatch. Okay. So in case they want to borrow more than the budgeted, they will again have to go to the central government for approval.
Thanks, Anurag, for answering the question. Participants, if you have any further questions, please type into the chat box and we'll be more than happy to answer them. In the meantime, we have one more participant asking this question. In fact, RBI had sought last week, feedback on the Indian bonds being listed on the Euroclear, platform. So, do you see what is this concept to start off with for people who have not heard of it? And B, does it impact the Indian mutual funds or the bond markets any way? And how does it impact eventually the mutual funds?
So there is no direct impact of mutual funds of Euroclearability. See what for in an audience who are not aware why the Euroclear is important for what something bond market participants are looking at. So broadly, so Euroclear is a largely a bond trading platform where bonds of various nationalities are currently being listed and traded. One of the problems that India has faced with bonds being listed on Euroclear is withholding tax. Since India levies a withholding tax on certain class of investors, it becomes difficult for Euroclear to track that who is the right investor and what's the tax treatment of that investor. And hence, Euroclear has appealed to the government of India to have a consistent set of regulations across all the class of investors and preferably remove the withholding tax to avoid any operational issue on Euroclear. Of course, we have various public statements from various finance ministry officials that they don't want to take any knee-jerk action on withholding tax. They want to move the treatment of withholding tax through OECD committee on double tax avoidance. So they want a consistent treatment of withholding tax across all the major economies, and then only they want to take any action there. So, however, why it is important for bond market participants is if you look at various bond indices, various global bond indices, they are looking at India to include our government bonds in their various bond indices. Uh, and hence, and Euroclear has been one of the prerequisites for many such bond index providers. Although it's not necessary for a bond to be on Euroclear to be part of the bond index, but having a bond listed on Euroclear increases the probability significantly. So as the size of government bond borrowing has grown post the COVID world. So if you look at government bond borrowing, which used to be 7-8 lakh crores on a gross basis pre-COVID, which has now moved to 15-16 lakh crores, a lot of bond market participants have been suggesting to the government of India and RBI that probably an index inclusion will open an additional avenue for investment flows structurally, and it will probably not be hot money because being an index will continuously lead to at least passive investors tracking the index and deploying money in Indian government bonds. And hence, on news reports of RBI querying, with banks, there was an expectation that probably India can be included in bond index if government of India agrees to list bonds on Euroclear. So it's not just a government of India decision. Euroclear also has to agree whether they want to include government of India bonds despite the withholding tax. And index inclusion is totally a separate discussion because there are many economies which have a withholding tax, but they're still part of the bond index. So it's not really a necessary condition for a country not to have withholding tax to be part of these bond indices. So these are two separate matters. From like we keep on saying to an average asset allocator. So unless and until one is wanting to trade tactically, which we never advise, one should look at systematic allocation to mutual funds. And hence, from a asset allocation perspective, we don't think that an investor should largely bother about these things. I mean, we have a very well diversified government bond market in India. An investor today can benefit, like we said, if they want to benefit from a shallow rate cycle, they can benefit from moderate duration products, or there are plethora of index funds as well as actively managed gilt funds which can do this work for those investors. So that's largely, our view what this event would be.
So thank you, Anurag, for sharing your thoughts on what the inclusion would mean in the Euroclear platform. Also, so since we are approaching the fag end of the session, and I think we have time for just one more question. Maybe one last question coming from a participant, Mr. Deepak Gupta. This is a question again going back to the Federal Reserve. So he has asked a very interesting question. How long can Federal Reserve, in your view, is capable of servicing its debt with such high interest rates? So that's a question that he has posed. It's a very interesting one. So maybe we can take it with the last question for the session.
So this has been a concern which has been raised at many quarters that at some point of time, maybe the US government debt could become unsustainable. Having said that, see, one of the ways where many economies or many countries, which you would see in the last 12, 18 months, which have gone into debt restructuring, or they would have gone into debt restructuring in the past 10, 15 years, the main issue comes in offshore borrowing. As far as local borrowing is concerned, since you can print theoretically unlimited amount of your own currency, usually governments don't default on their domestic borrowing. It's usually on the offshore borrowing that typically governments have problems servicing in case of shortfall in revenues. The US has an exorbitant privilege because most of the global trade, most of the global FX reserves is denominated in US dollars. So theoretically, US can print dollars as much as it wants and continue to service its debt. So, of course, printing your currency in a more, in much higher than the usual, much higher than usual trend can lead to problems of inflation, can lead prices of asset prices instability, but it does not mean that the US government, at least for now, runs the risk of not being able to service its debt. Given that, and if you look at, people keep on talking of will grow in insignificance. As of now, at least there is no alternate to dollar. Probably at some point of time there would be, but till the US dollar remains critical for the global economy. Uh, of course, even today, if you see, given the high fiscal deficit, it's leading to high inflation in the US. It is leading to asset price fluctuation, but it is not leading to issues on sustainability of US debt, at least in the near term. So we do not think in the near to medium term would be any risk of servicing of US debt.
Yeah, so thanks, Anurag, for taking us through, these insights that you have shared, and taking questions from the participants. Dear participants, we would appreciate if you would share your feedback with us on the link given below. And I would maybe end here and request Anurag to maybe sum up and share his last thoughts before we close this session.
Thanks, Farhad. So broadly, like I said, while we saw some extreme weather events in the last 2 months, which has led to commodity price shocks both on the food as well as in the oil price world, we largely believe that inflation has peaked, and although the current inflationary pressures has resulted in maybe a longer pause from many central banks, but the next major policy moves would be lower than higher. Uh, we are at a very reasonable starting point of valuations across the yield curve, and hence investors, according to the time horizon, can start to look at various high quality fixed income strategies. So that's largely from us. There would be, given the, of course, that we are still unwinding from a post-COVID world, there could be some temporary shocks and slightly higher volatility than what we would have seen, but that's par for the course. But we do not see any major, negative surprise on the rate side from here on. So that was it from our side. Hope our investors found the session useful. Thanks a lot. Good day.
Thanks, Anurag. Thank you, participants. And looking forward to seeing you next month. Have a great day ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.